Welcome to our journey through the realm of income investing, a strategy that holds immense potential for generating regular income from your investments. This world of finance is rich with possibilities. Now you may wonder, what is income investing? Simply put, it's an investment strategy that involves building a portfolio of assets that generate a regular income stream. These assets could be dividend-paying stocks, interest-bearing bonds, or real estate properties. The idea is to create a robust and diverse portfolio that can provide you with a steady income stream, much like a paycheck, even when you've stopped working. But there's more to it than just generating income. It's about striking a balance. On one hand, you want your investments to provide a steady stream of income. On the other hand, you want to preserve the capital you've invested, ensuring that your nest egg remains intact, even as you draw income from it. And let's not forget the specter of inflation. For those in or nearing retirement, inflation can be a silent wealth killer. It's crucial to ensure your income not only keeps pace with inflation, but ideally outpaces it, preserving your purchasing power in the long run. So, as we embark on this journey, remember that income investing isn't just about generating income. It's about preserving your capital and protecting against inflation. It's about creating a financial buffer that lets you enjoy your retirement without constantly worrying about money. As we delve deeper into this topic, you'll realize that income investing is not just about income generation, but also about capital preservation and inflation protection. As you age, your investment strategies ought to evolve. This is where income investing comes into play. It's a unique approach that shifts the focus of your portfolio as you progress in life. The essence of this approach lies in the careful balance of your assets to optimize income while preserving capital and protecting against inflation. This balance becomes increasingly crucial as you age. You see, as investors grow older, their risk tolerance often diminishes. This change in risk appetite leads to a shift in portfolio composition. The mix of assets starts to lean more towards bonds and real estate. Why bonds and real estate, you might ask? Well, bonds, especially those with a good credit rating, are generally stable and reliable. They provide regular interest payments, which can serve as a steady stream of income. And that's a comforting thought when you're planning for retirement or are already in your golden years. On the other hand, real estate, particularly through real estate investment trusts, or REITs, offers the potential for rental income without the hassle of direct property ownership. Real estate often serves as a hedge against inflation, which is a crucial aspect of income investing. Not to mention, it can also appreciate in value over time, adding an extra layer of capital preservation. But remember, while bonds and real estate tend to take a larger portion of the pie as you age, it doesn't mean you should forego other asset types. Dividend-paying stocks, for example, can offer reliable income and potential growth. They bring a different kind of dynamism to your portfolio that can be beneficial. In essence, the aim is to achieve a harmonious balance between these different asset types. Each one has its role to play, its strength to exploit, and its risks to manage. Together they form a well-rounded, resilient portfolio that can stand the test of time and market volatility. Remember, the key to a successful income investing strategy is a well-balanced portfolio that can weather market fluctuations. Annuities. They may sound like a safe haven, but it's essential to tread carefully. Now, what exactly are annuities, you might ask? Well, simply put, annuities are financial products that pay out a fixed stream of payments to an individual. These financial products are primarily used as an income stream for retirees. Annuities are often lauded for their ability to provide a guaranteed income. This feature can be particularly appealing, especially when planning for a financially secure retirement. After all, who wouldn't want a steady income flow that's immune to the whims and uncertainties of the market? However, as with any investment, annuities are not without their drawbacks. Often these products come with high costs. Fees for annuities can be notably higher than those for other investment products. These costs can eat into your returns, and over time they can make a significant dent in your retirement savings. Another potential downside of annuities is their inflexibility. Once you commit to an annuity, it can be challenging to change the terms or access your funds. This lack of flexibility can be a significant drawback, especially if your financial needs change over time. It's also worth noting that while annuities can provide a guaranteed income, this guarantee is only as good as the insurance company that backs it. If the company goes under, your annuity payments could be at risk. So, while annuities may seem like an attractive option for income investing, they are not a one-size-fits-all solution. It's crucial to understand all the facets of these financial products before taking the leap. Consider your financial goals, your need for liquidity, and your tolerance for risk. Consult with a financial advisor to make sure you're making the best decision for your personal circumstances. Annuities might be an attractive option, but it's crucial to weigh their benefits against their limitations. Remember, in the world of investing, knowledge is power, and the more informed you are, the better your decisions will be. High-yield investments can be tempting, but they come with their own set of risks. Now let's take a closer look at the world of high-yield investments. They're like the siren song, promising returns that can make your eyes twinkle with anticipation. But as the old adage goes, if it sounds too good to be true, it probably is. High-yield investments typically involve more risk. This is because the higher the potential return, the higher the potential loss. A company offering high yields may be doing so to compensate for its higher risk of default or other financial instability. Think about it like this. If you're walking a tightrope, the higher you climb, the harder you can fall. High-yield investments are the financial equivalent of that high-wire act. It's thrilling, and the view from the top can be breathtaking, but a single misstep can have catastrophic consequences. Moreover, high-yield investments can be less liquid than their lower-yield counterparts. This means that you may find it more difficult to sell your investment when you want to, or you might have to sell it at a loss. Liquidity risk is something that every investor needs to consider, as it can impact your ability to react to market changes. And let's not forget about the impact of market volatility. High-yield investments are often more sensitive to market fluctuations, which can lead to significant variations in their value. This can pose a real problem if you need to access your capital quickly. So while it's easy to be enticed by the promise of high returns, it's crucial to approach high-yield investments with caution. Always ensure that you fully understand the risks involved before diving in. Remember, investing is not just about chasing the highest returns, it's also about preserving your hard-earned capital and achieving sustainable growth over the long term. The allure of high returns should never blind you to the potential risks involved. In the world of investing, diversification is your best friend. This phrase is more than just a catchy line, it's a cardinal rule that seasoned investors live by. So, what does diversification really mean? Well, it's all about spreading your investments across a wide range of assets to mitigate potential risks. Think of it this way. Imagine your portfolio as a well-balanced diet. Just as you wouldn't rely solely on one type of food for nourishment, you wouldn't put all your financial eggs in one basket. A healthy portfolio, like a balanced diet, requires a mix of different asset types. Now let's delve deeper into the key assets in income investing: dividend stocks, bonds, and real estate. Dividend stocks are shares in a company that pays out a portion of its profits to shareholders. These offer both a reliable income and potential growth, making them an attractive option for many. On the other hand, we have bonds. When you buy a bond, you're essentially lending money to an organization in exchange for regular interest payments. Bonds provide stability to your portfolio, acting as a buffer during market downturns. Lastly, real estate investments. These could be real estate investment trusts or REITs, which offer rental income without the need for direct property ownership. Alternatively, rental properties can be part of your income portfolio, though they do come with additional responsibilities. Each of these assets brings its own set of rewards and risks. That's where diversification comes in. By spreading your investments across these different asset types, you're not only cushioning your portfolio against potential losses, but also setting yourself up to benefit from diverse income streams. So remember, a well-diversified portfolio is like having your fingers in many pies. It's not about chasing the highest returns, it's about creating a stable and reliable income source that can weather the ups and downs of the market. Diversification doesn't just spread your risks, it opens up multiple avenues for income generation. Let's explore the different asset classes that can become part of your income investing strategy. As we delve deeper into the world of income investing, we encounter a variety of asset classes that can be incorporated into our portfolios. Each asset class comes with its own set of advantages and challenges, so understanding these is key to building a successful income investing strategy. First, let's look at dividend-paying stocks. These are shares of companies that distribute part of their profits to shareholders. The beauty of dividend stocks lies in their dual benefit. They offer a reliable income stream through regular dividend payments, and they also have the potential for capital growth if the company performs well. However, they are subject to market volatility and the risk that a company may cut or eliminate its dividend. Next, we have interest-bearing bonds. Bonds are essentially loans that investors make to governments or corporations. In return, these entities pay interest at regular intervals and return the principal amount when the bond matures. Bonds are often considered safer than stocks, providing stability and regular income. However, their yields can be relatively low and they are subject to interest rate risk. Then there are real estate investment trusts, or REITs. REITs are companies that own income-producing real estate, from office buildings to shopping centers to apartments. Investors can buy shares of REITs on the stock market, just like any other company. The key benefit of REITs is that they offer the opportunity to generate rental income without the need for direct property ownership. However, like all investments, REITs come with their own risks, including property market fluctuations and management issues. Finally, let's talk about rental properties. Owning rental properties can be a profitable venture, providing regular rental income and potential appreciation in property value. However, it's important to remember that owning rental properties comes with additional responsibilities, such as maintenance, tenant management, and dealing with vacancies. Each of these asset classes can serve a specific purpose in an income investing strategy. Dividend stocks for growth and income, bonds for stability, REITs for passive real estate income, and rental properties for direct control over real estate assets. Choosing the right mix of assets is crucial in building a robust income investing strategy. Remember, diversification is key, and ensuring you have a balanced mix that suits your risk tolerance and income needs is paramount. So, there we have it. A comprehensive look at income investing. We've journeyed through the basics, understanding that this strategy is not just about generating regular income from investments, but also about balancing income generation, capital preservation, and inflation protection. It's about more than just grabbing the highest yields, it's about creating a foundation for financial security, especially in the golden years of retirement. We've seen that portfolio composition is crucial, and that as investors age, the mix may shift towards a higher percentage of bonds and real estate. Bonds, with their stability and regular interest payments, can provide a steady stream of income. Real estate, whether through direct property ownership or through real estate investment trusts, can offer rental income and potential appreciation. But let's not forget the double-edged sword of annuities. While they can guarantee income, they can also be expensive and inflexible, reminding us that there's no one-size-fits-all solution in income investing. High-yield investments, tempting as they may be, should be approached with caution. The promise of hefty returns often carries higher risk, and chasing yield without a clear understanding of the risks involved can be a perilous path. And finally, we've underscored the power of diversification. Spreading your investments across different income-producing assets, including dividend-paying stocks, bonds, and real estate, can reduce risk and increase the potential for steady, reliable income. So, whether you're a seasoned investor or just starting out, remember that income investing is about balance, caution, and diversification. It's about building a portfolio that not only generates income but also stands the test of time. Did you find this video helpful? If so, please subscribe to my channel and give this video a thumbs up. I look forward to guiding you through more financial journeys. Until then, happy investing.